Hey everyone, welcome back to Corporate Decoder, the place where we untangle those twisty corporate filings so you don't have to. Today we're diving into a report that's a bit like admitting you accidentally set the kitchen on fire, but promising you've bought a new fire extinguisher. We're looking at HNO International, and it seems they've had a little oopsie with their past financial statements. They're basically saying, sorry, those numbers from before, yeah, they weren't quite right. So buckle up as we explain the what, the why, and the uh-oh behind this financial facepalm. First things first, this is an 8K filing. Think of it as a corporate uh-oh moment report. Companies file these when something big happens that investors need to know about right away. It's not the regular quarterly or annual report, it's for when something unexpected pops up. Now, the date that matters here is late February of 2025. That's when they realized they needed to set the record straight on some previous numbers. Here's the heart of the matter. HNO International is saying that you shouldn't rely on their past financial statements from the year ending in October 2023. It's like saying, hey, that map we gave you, it might lead you off a cliff. So why the change of heart? Well, they hired a new accounting firm, Barton CPA, after their previous one got into trouble with the SEC, the Securities and Exchange Commission. Think of the SEC as the cops of the financial world. Basically, their old accountants got benched, and the new guys came in and said, hold on a minute, something's not adding up here. Barton was hired to audit the financial statements for the years ending in October 2023 and October 2024. These faulty financial statements were originally reported in their Form 10-K, which is the annual report that goes much more in depth than the quarterly reports. To reiterate, the board of directors concluded that the report that was filed with the SEC in January of 2024 should no longer be relied upon. The issue boils down to how they valued stock-based compensation. Basically, they messed up how they calculated the value of stock they gave to employees. It's like pricing a used car way too high or way too low, and it needs an adjustment. Because of the updated fair market value assessment, there was an increase in the share-based compensation expense. Share-based compensation is just a fancy way of saying the company is paying its employees or executives with shares of stock rather than cash. And it had corresponding adjustments to additional paid-in capital and accumulated deficit. Additional paid-in capital is money investors paid over the par value of the stock, and accumulated deficit refers to a company's losses over time. The bottom line is correcting the fair market value stock valuation adjustment will result in an increase in net loss of about $467,775 for the year ending in October 2023. Ouch, net loss simply means the company lost that money after calculating all income and expenses. They plan to fix this in their next annual report, which will include revised financial statements for the October 2023 year, along with the regular disclosures for the most recent year. The company has noted their remediation efforts are ongoing, and they want to implement better practices, procedures, and internal controls. Finally, the company's management and the board of directors have discussed with Barton CPA, the company's independent registered public accounting firm, the matters disclosed in this current report on Form 8K. So what's the takeaway here? Well, it's never good when a company has to restate its financial statements. It raises questions about their accounting practices and internal controls. In other words, it doesn't instill a lot of confidence. In HNO's case, the error seems to stem from miscalculating the fair market value of stock-based compensation. While the dollar amount isn't enormous, it's still significant enough that they had to issue this public correction. Looking at the company's direction, this hiccup definitely raises some concerns. It suggests potential weaknesses in their financial reporting processes. On the other hand, the fact that they caught the error and are taking steps to fix it is a positive sign. It shows they're at least trying to be transparent and accountable. As for risks and opportunities, this situation could damage investor confidence, potentially leading to a lower stock price. However, if they can successfully address the underlying issues and demonstrate improved financial oversight, they could regain trust and attract new investors. In conclusion, HNO International is facing a challenge right now. They need to convince investors that this was a one-time mistake and that they have the right systems in place to prevent it from happening again. Their upcoming annual report will be crucial in demonstrating their commitment to accuracy and transparency. Alright, that's all for this episode of Corporate Decoder. If you found this breakdown helpful, be sure to like this video, leave a comment below, and subscribe to our channel for more insights into the world of corporate filings. We'll see you next time.